You're very welcome to another episode of the Corporate Governance Podcast, brought to you by the Corporate Governance Institute, providing quality education for the next generation of directors and other corporate leaders. This podcast is about exploring what's new in governance, the challenges, the opportunities, and how we make the most of them. I'm your host, Dan Byrne, and I'm joined today by Stefan Steinhardt, experienced CEO who has worked for SGS, market leader in testing, inspection, and certification industry, as well as family-owned and private equity finance companies in the same area. Stefan is a graduate of CGI's Diploma in Corporate Governance. He's based in the German capital, Berlin, but his governance and managerial career has seen him working in many member states of the European Union and beyond its borders. For the near future, he'll be very active as a non-executive director, or NED. Today, we're going to discuss how important it is in a modern governance career to adapt to changing structures and what that task looks like in practice. Stefan, very welcome to the podcast. Delighted you could join us.
Yeah, thank you very much. It's great being here.
To begin, we'd love to learn a little bit more about you. So could you briefly tell us something about your governance career and what drives your interest in it?
My journey in governance started over 25 years ago, and it was a very exciting journey. I had many roles, so from CEO and CFO, managing director. I worked in quite a lot of different industry like banking, private equity, testing, inspection, certification, mining and facility management. Also in different regions in Europe, like in Germany, but also UK, the Baltics, Southeastern Europe, as well as in Russia and in the Ukraine. I have worked for family-owned businesses, big companies that are listed on the stock market, but also for private equity-backed companies. Each shareholder structure brings its own challenges and priorities, of course. And all these differences is a lot of challenge when it comes to governance. You have to consider all these differences in culture, regulation, and shareholder priorities. And it's crucial as a manager, but also for a board member to be highly aware of all these differences. So what my interest is in corporate governance in this context is building a strong company structure with a robust culture that supports the company's purpose. For me, a good governance is like the backbone of a company. It makes sure that everything is transparent, honest, and runs smoothly.
And we were talking before this podcast, and you're of course based in Germany, and it's quite a different structure in governance in Germany and indeed much in continental Europe. There's a gap between the sort of Anglo-Saxon governance model and the governance model used in Germany. And just for anyone who's unfamiliar listening, would you be able to explain briefly what that difference looks like?
Yeah, thank you for this question. I think it's important to understand the differences. So first of all, each model has its strengths and weaknesses. And the best choice often depends on the special context and, of course, the country you are in. The Anglo-Saxon model, which is very common in UK and the US, is typical. They have this single board or of directors. So the board is responsible for both for the management and the oversight of the company. So directors are usually a mix of executives who work for the company and non-executives who are independent. The Anglo-Saxon model with its single board of directors tend to be more agile and efficient in decision making. This can be an advantage when you are in fast-paced industry where quick responses are crucial. However, it can sometimes lead to less oversight and high risk of conflict of interest, since the same board is responsible for management and oversight. On the other hand, the continental model, which is popular in Germany, has a two-tier board system. That means you have two separate boards, the management board and the supervisory board. The management board is responsible for the day-to-day business running the company, while the supervisory board oversees and advises the management board. So the supervisory board is made up of representatives of the shareholders and employees. And this ensures very different perspective that are considered when it comes to the oversight of the processes. So the continental model, which with its two-tier system, provides a clear separation between management and oversight. This can enhance check and balances, reduce conflicts of interest, and involves a wide range of stakeholders in the governance structure. So in Germany, for example, we have employees, representatives in the supervisory board, ensuring that their interests are also considered in the decisions. This can lead to more sustainability and social responsible decisions. However, this two-tier system can be slower and more bureaucratic, which might be as a disadvantage in a very dynamic industry. So at the end, the model, there is no inherent better or of these models. It really depends about the context, what model fits best. Both model aims to achieve the same thing, good corporate governance, but they do it in different ways.
I was wondering if you have, in your career, have ever seen any increasing interest amongst the continental governance community for the Anglo-Saxon model, or vice versa, or do you see these corporate cultures as keeping quite separate? Have you seen any trends there?
Yeah, in the moment where you have Anglo-Saxon investors in Germany, you very often see something like a board of directors who takes a decision. However, you have to respect the legislation in Germany. So it's then you really have a mixture. Yeah, you have on one side you have this board, and you have the supervisory board in Germany, because that's part of the regulation, and you need to have this. But as soon as you're dealing with Anglo-Saxon investors, have a little bit difficulties to understand the complexity of this supervisory board and the participation of the employees in the supervisory board.
So there's a little bit of getting used to the new system, sort of catching up with the local customs, I suppose.
Absolutely, local customs, and also with a regulation.
Well, it brings us on to the next question very cleanly, and that is that, you know, especially when we draw into Europe, Europe is a very dynamic continent with lots of different borders, lots of different rules as soon as you cross one. And you've seen a lot of that activity. You've been involved in that, as you say, for the last 25 years. And I was just wondering, in your career, what areas have you seen the biggest differences between jurisdictions when it comes to corporate governance? Would it be in terms of the rules? Would it be in terms of the perceptions of the rules, or the approaches to how you govern a company? What stands out for you?
Yeah, well, the difference in corporate governance across Europe regions have an important implication when you look from the perspective of a German investor or UK investor. For a German investor, robust legal framework and strong stakeholder engagement in Germany provides you a high confidence in corporate governance. When you consider then like the Baltics or the Southern Eastern Europe, there might be need to adjust your expectation for the German investor, and your due diligence process has to be quite severe and detailed. In the Baltics, there is a more flexible governance structure and innovative environment that can create a lot of opportunity, but they also become less strict in the regulatory oversight compared to Germany. In Southeastern Europe, there are ongoing improvements in the governance standards. That is quite promising, but investors should remain vigilant about the transparency and enforcement issues in these countries. From a UK investor perspective, used to the single board system and the principle-based approach in governance, that, as I've said before, the two-tier system might be in Germany seem to be quite complex, and on the other side, it's clear and assures these check and balances. When a UK investor looks more to the Baltics, they might appreciate the similarities in governance model and the entrepreneurial spirit. However, like the German counterparts, they should be also aware of regulatory differences and the level of market maturity in these countries. And my experience with Russia, because I also were responsible for Russia, and this was before the conflict in Ukraine, I see both German and UK investors need to be particularly cautious. While there are opportunities in this country, or there were opportunities before the war, the governance challenges are immense, with respect to shareholder rights, transparency, and state influence, and this requires a very thorough due diligence and even a very high risk tolerance for this country.
So we're talking about, I think, differences in culture, but differences that permeate everything from the rules to the people following the rules. It's just these differences can essentially exist on all levels.
Absolutely right. You have the very differences in the cultures and how people working in this country. You have the different jurisdiction and different rules, and this really has to be to consider, and you have to be very sensitive of these differences when it comes to be a manager or a member of a board.
I was wondering, do you have any insights into how best a director might find out the main differences? I mean, rules are probably easier, right? Because you can just go to the regulator and look at governance differences. But for the cultural aspect of governance, do you have any insights on them off the top of your head about as to where a director can go for this information?
I mean, there is no booklet, what's the culture in the different countries. I think what is very, very, very important is, let's call this emotional intelligence, to understand what is driving the people in different countries. And let's say in Germany, people like to be very structured and planned, while in Italy, people are a little bit more flexible and creative in their way. And you have a different communication style in this country. So you really have to be sensitive to the different culture and to the emotion of the people. And you have to pick it up, and you just have to be aware of these differences. You cannot expect people in the Southeastern Europe being like someone in Germany or in the UK. Be aware that they are different.
Yeah, and it goes through all aspects of corporate life as well. I wanted to turn to this, because we've done the rules now, and they're very different across Europe. I wanted to turn to shareholder structures and ask the same question of you. What do you think the key differences are in terms of shareholder structure? So not necessarily across borders, but across different types of governance layouts.
Yeah, absolutely important. The type of shareholder structure have a significant influence on the governance approach in the company. And there are some key differences. So I experience family-owned companies, public traded companies, but also private equity-backed companies. And in my experience, in family-owned business, governance often reflects the family values and the long-term vision of the family. Decision made quite centralized with a focus on stability in legacy. And as non-executive director, you should be very sensitive to the family dynamics and the founder's vision. You have to balance the family interest with the need of a professional management, and external perspective. This is what you bring to the table. And you should focus on maintaining objectivity and engaging in adopting a formal governance process, but at the same time, not frightening family members. So it's a balancing. It's a balancing act. When it comes to public traded companies, public traded companies are subject to very stringent regulatory requirements and have a very high level of scrutiny from shareholders and regulators. Governance typically emphasize on transparency, accountability, and shareholder value. So the standard principles. As a non-executive, you must be particular vigilant about compliance, risk management, of course, and ensuring that the board is independent. So there really is a standard, a classical governance approach. There's a strong focus on short-term performance also in these public traded companies due to this quarterly reporting. So what you need to do and where you can bring value is creating a balance between short-term results and a long-term strategy. And that's, I think, a very important role where you can contribute value to the company as a non-executive director.
Absolutely.
When it comes to the private equity-backed companies, governance in a private equity-backed firm is often driven by the goal of maximizing value within a specific investment horizon. And as a non-executive, you need to understand first the private equity firm objective and work towards very aggressive performance targets. You should also be prepared that the financial performance and the operational efficiency is really top agenda point when it comes to board meetings. So being sensitive on the pressure for these short-term results, but at the same time, ensuring a sustainable long-term growth of the company is something where you should, as a non-executive director, focus on and bring value to the company.
That's a huge spectrum that you've described of differences between from all the way on one side on the family-owned companies to the private equity firms on the other side. And, you know, we live in a modern Europe where directors will change companies, industries, and will need to adapt to these things. So I was just wondering, from your experience, how important is it for directors to focus on adapting to all of these different corporate structures and all of these different corporate cultures? How critical is all of that?
Yeah, I mean, the adapting to these different structures and cultures is incredibly important for directors throughout their entire career. Yeah, and I make some example. Yeah, imagine a director who has experience in a public traded company in the UK, where there is this single board system and a very strong focus on shareholder values. If this director joins a German company with this two-tier system, they need to understand the roles of the management board and the supervisory board. So he has to be adaptive to this new system. At the same time, if the director is able to adapt to this system, I'm very sure that he effectively can contribute to the corporate governance of this company and creating very good oversight and advices to the board. Another example is with this adaptability, you can bring a lot of new perspective to the company. And here a very good example when you consider a director who has worked in a family-owned business and in a private equity-backed company. So from the family-owned business, the focus on long-term stability, and maintaining family values is important. In contrast, in this private equity-backed firm, the priorities are more on growth and return. So experiencing both, the director, he can contribute the long-term perspective thinking from the family business to the companies, but at the same time ensuring the fast-paced environment a private equity investor is in, and ensuring a sustainable growth. So there's also, with this adaptability, a strong gain for the direct and for the companies. And maybe a last example, which I came across, is, for instance, you can quite enhance the governance practice, your experience. For example, a director with an experience in a highly regulated industry, such as banking. And he joins a company in the emergent fintech sector. He brings with them a deep understanding of compliance and risk management. And by adapting these best practices to the fintech company, this can help the company navigate much better through these regulatory challenges and building very robust governance structures for this fintech company. So adaptability is important. And by this, the director definitely be more efficient and generate value for the board.
It's interesting because when I was thinking about this question, I automatically just jumped to the fact that it would be challenging to adapt from one system or structure to another. But actually, from what you said, there's actually advantages of being sort of an outsider culturally or structurally, in that you can bring a perspective that was perhaps missing before.
Yeah, absolutely. Yeah, I see it as a positive, and therefore, one of the important skills a director should bring is the adaptability to the different systems, but at the same time bringing the best from his background to the board, and having this here also as a very positive impact for the company.
Yeah, brilliant. So I wanted to turn then to the actual art of governing a company that stretches across European borders. It's a very complex system. Sometimes there's international laws made in Brussels that everyone has to follow. And then, as you said, there are also local laws and customs that need to be followed too. So I guess you've touched on it a little bit already, but what would you say are the main challenges that a director is likely to face if they're governing a cross-border entity in Europe?
Yeah, I mean, there's always a lot of challenge when you're dealing in this environment, but definitely the most important, and you mentioned it, is these countries, they have different set of rules and laws. Yeah, and for instance, in Germany, things are not allowed what is allowed in Spain. Yeah, and the director needs to know the local law and make sure the company follows the laws in every country where they are in. Yeah, think about driving a car. Yeah, in one country you drive on the right side, in another country it's on the left side. You need to follow the local rules to avoid an accident. So definitely know the rules and the laws is important. Second, there are cultural differences. We touched about this issue already at the beginning. People in different countries have different ways to work. For example, maybe this is a stereotype, but Germans might prefer detailed planning in structures, while Italians might be more flexible and creative. So as a director, you really need to respect these differences and find a way to bring everything and everyone together. Europe is big and there's a lot of languages, and the languages are definitely a challenge. Not everyone speaks the same language, and misunderstanding can happen. And for instance, if a French team member says yes, but he means maybe, it can cause confusions. So the director needs to ensure a clear communication. You might have a translator, or even you learn some key phrases in different languages, but be aware and be very precise in your communication. Europe is very different when it comes to economics and political systems. Each country has its own economic and political situation. For instance, in Germany, we have more or less a stable economy, but at the same time, in Italy or now in France, where Macron dissolved the National Assembly lately, you have a completely different system. And as a director, you need to be ready for these changes, and you must have a plan on hand when it comes to these changes in economic or political situation. Yeah, there's maybe one thing which is also a big challenge, and this is very important, and I always experience this, is the tax and financial system in the countries are very, very different. Yeah, and director, make sure that you pay the right tax in the country you're operating in.
It's incredibly interesting, the point you made about, you could be working just normally on your company's board in one nation, and then you step across the border and they're suddenly in the middle of an election campaign. And I mean, I guess the entirety of Europe went to the polls just last week based on when we're recording this, but it's not usually like that. And you do find that, national current events can sweep up companies into, a churning cycle that might just not be the case across a border, even though it's next door. And it seems like that's just the norm, and you have to try and navigate that.
Absolutely. Yeah. And you have to be really well informed and be aware, and you have to have a plan for this scenario.
Yeah. And also what you said about the, being wary of different cultures. And I guess it matters hugely important for a board of directors in that, boards are often the source of corporate culture. So there really is a top-down filtering aspect to it. And you really do have to get that tone right at the top, don't you? When there's cultural differences to consider.
Yeah, and I think this is one of the skills every director should work on, and which is important are really the communication skills. Yeah, by finding the right tone in the right situation, in the right culture to the right people.
It feeds into the next question, which was, how do we overcome those challenges that you described? So we have communication skills, and a lot of this, I presume, correct me if I'm wrong, is a lot of this learned by experience. And what are the things can experience teach you in terms of overcoming these challenges?
Yeah, okay. For instance, communication, I think it's you should be very clear and in your communication and use a simple, understandable language. And as I said, it might be even helpful to have some phrases in this different language country that you can communicate a little bit with them. But also with communication, be aware there is different communication styles in these countries. Like in Germany, a direct and precise communication is appropriate, while in UK, being more polite and sounds indirect is common. Mm-hmm. In Southeast Europe, people might be there are more gestures and more expressiveness in the communication. And these are different communication styles, and you have to understand there are different communication styles, even if it's in your own country, maybe not common, but in this country, that's how they are communicating, and be aware of this one. And you can improve on this. And then we come to, because it goes along, communication, and there are cultural differences in Europe. Yeah, for coming back to the stereotype, German value punctuality and detailed planning. Whereas maybe UK people might appreciate a more flexible approach and enjoy a bit more humor meetings, whereas the Southern European employees and colleagues, relationship and trust is key. And business discussion often happens over long lunches. Yeah, so there are cultural differences, and respect these differences. This is absolutely something which is important to overcome these challenges. And of course, the rules. Yeah, you should really spend time understanding the law and regulation in this country. And this is part of every good due diligence, that you say, okay, what are the regulations in the industry we are in, and what are the rules and laws in the country we must respect and we should be aware of as director. So there's a couple of things. And when it comes to finance, hire good accountants and finance advisor who knows the country rules, and because a lot of rules and laws change very often in the countries. You cannot be up to date on all these changes by a lot of countries. So you need to have people in the country who knows the rule, and it does make sense, save money here and get the best accountants and finance advisors for your company to make sure that you are in line with the financial regulation in this country.
Hugely important. And It's something that I was also wondering as well, we could talk about a little bit, which is skill sets on the board. So if we take, for example, a modern director who operates across borders, or even a modern company whose board needs to oversee cross-border regulations, what do you think the best skill sets are for people in this situation? What should people be looking for?
Oh, yes. I mean, it really comes with these challenges, and my maybe 5 most important skill sets are cultural awareness. And the director really should respect the culture, as I said. The Germans, punctuality, detailed planning. The British appreciate humor and flexibility. Southern European people, relationship, trust is key. Yeah, and being aware of these cultural differences. Go in this country with an open eye, and then we will see. Second skill is communication skills. Being able to communicate clear and adaptive your style to the different audience is crucial. Yeah, the Germans, direct, precise communication works best. Yeah, UK are more polite, and sometimes indirect approach is appropriate. And Southeastern European, they are very expressive, passionate about communication. That's their style, and you have to understand this and accept this, and so it's very important to have these good communication skill. And then when you have so many differences, adaptability is absolutely key. So you as a director, you need to be flexible and open to changes. For instance, there is, as we had the Brexit in UK, there was a lot of changes. Yeah, you had to adapt, and to this situation, you have a lot of constant changes in economic and political situation in Southeastern Europe, or also here in Central Europe, and be adaptable is key. A fourth skill set is definitely problem solving. So you have to be flexible and pragmatic when it comes to problem solving in these different countries and these different cultures, and when you have a different shareholder structure. And finally, and I think I mentioned this at the beginning, absolutely key is emotional intelligence, how I call this. Yeah, directors should understand and manage their own emotions and those of others. This is very crucial when you're dealing with diverse teams. So you have to understand and have to feel, you realize when a German colleagues prefer a structural approach, or a British colleague enjoys humor, or the Greek colleague values personal connections. So having a sense for these emotional needs of the people is a very, very strong skill a director should have.
Well, we're at the end of the podcast now, but I just wondered, based on all of what we've discussed, is there a key takeaway that you would like listeners to remember about the episode? Any advice for those who are on international boards or international companies for the present or the future?
I think it's a great question to wrap up this podcast. Maybe there are 5, in my opinion, 5 key points which can be remembered. One is definitely the adaptability. So be flexible. Yeah, whether you're working in a very structured environment or in a very innovative environment like UK, or in a very more personal environment and culture like in Southern and Eastern Europe, adapt to this different style. One thing is also important, and I think it comes with every good director: stay curious and keep learning. Never stop learning about the cultures and the regulatory environment and the countries you're operating in. And by the way, it's also fun to learn something new and to deal with these different cultures. Building strong communication skill, I mentioned this already. It's very, very key. The emotional intelligence is one of the very, very important way of these. So when I sum up, embrace diversity, stay adaptable, communicate effectively, be aware of your and your team's emotion, and always keep learning.
It sounds to me like the makings of a very good corporate culture, which I know a lot of organizations struggle to reach, but there you go. You've laid it out quite succinctly there, I think, Stefan.
Thank you.
Well, listen, we're going to leave it there for today. Thank you again, Stefan, so much for illuminating the importance of adapting to different cultures and different governance structures. And that's it for this episode of the Corporate Governance Podcast. Join us again for the next installment of this new series. And in the meantime, if you're looking to expand your leadership career with quality education in corporate governance and ESG, check out the corporategovernanceinstitute.com and explore the many opportunities we have on offer.